Hey students, welcome to week 7 of Accounting Principles. In this week's devotional, I touch on the topic of spiritual leadership. Not just leadership, but spiritual leadership. I hope you check this short video out in this week's introduction module. And by the way, if there are devotional topics that you'd like me to spend some time on, let me know. And I'd be glad to put together a devotional that's meaningful just for you. This week, we're going to start into chapter 3. And we'll be in this chapter for the next few weeks. So some of the topics we'll be studying over the next few weeks in chapter 3 include understanding net income, revenues, expenses, and the concept of business continuity, accounting periodicity, and accrual accounting. And then we'll also be studying the rules on when to recognize revenue. In fact, one of this week's questions is about Enron and how they violated the accounting ethics by cheating investors regarding recognition of revenue. They pulled up short on how they recognized revenue and violated ethics. Other topics we're going to be studying about in Chapter 3 include knowing how to prepare adjusting entries, preparing financial statements from an adjusted trial balance, and then more on cash flow and liquidity. Let's talk a little bit more about the details of this week. You know, earning a profit is an important goal of most businesses. Well, I think all businesses actually. One of the major functions of accounting is to measure and report a company's success or failure in achieving that goal. This is done by means of an income statement. And we've looked at income statements back in Chapter 1, and so you should be familiar with those by now. Net income is the net increase in owner's equity resulting from a company's operations. Net income results when revenues exceed expenses. But if it goes the other way, a net loss results when expenses exceed revenues. Revenue should be thought of as increases in owner's equity as a result of selling goods and rendering services or performing other business activities that generate revenue. Expenses should be thought of as the cost of doing business. Expenses decrease the owner's equity and result from the cost of selling goods or rendering services used in the course of earning revenues. Users of financial reports should be aware that assumptions play a major role in the measurement of net income and other key indicators of performance. The major assumptions made in measuring business income relate to continuity, periodicity, and accrual accounting. A little bit more about these terms. The issue of continuity arises as the difficulty associated with not knowing how long a business is going to survive. Because the majority of companies present their financial statements on the assumption that a company will continue to operate indefinitely, it's assumed that a company is a going concern. That's a phrase. A company is a going concern. It's assumed that it's going to go on forever. That is, unless there's evidence to the contrary, the accountant assumes that the business will continue to operate indefinitely as a going concern. If the accountant finds evidence that suggests the business may not be viable, the continuity principle falls apart and the business is no longer considered a going concern. The assumption about periodicity states that although the lifetime of a business is uncertain, it is still useful to estimate the business's net income in terms of accounting periods. Comparison of financial statements is possible through the use of accounting periods of equal length. So for example, a fiscal year is any 12-month period used by a company. Most companies' fiscal years start and end on January 1st and go through December 31st, but they don't have to. And those 12-month periods make it ideal for comparing one financial statement to the next. Let's talk about accrual accounting for just a moment. Under the accrual accounting concept, revenues must be recorded in the accounting period in which they were actually earned, and expenses must be recorded in the accounting period in which they are incurred. In other words, accrued expenses happen in the same accounting period as recorded revenue. The timing of cash received and cash payments, it's irrelevant. Opposite of accrual accounting is the notion of a cash basis for accounting. Unlike accrual accounting, in a cash basis accounting system, revenues are recorded in the period in which cash is received from customers or paid out to vendors. This method can lead to a distortion of net profit, though, for the period. So think about it. If you receive cash for services that you provided in January, but you don't pay for those expenses related to delivering those services until February, then your net profit in January is artificially high because it didn't include the expenses that generated the revenues for the company. So accrual accounting fixes that problem. Accrual accounting consists of 1, recording revenues when they were earned. All right, that's the revenue recognition portion. And then 2, recording expenses when the expenses were incurred, like when they were committed to. And then 3, adjusting the accounts at the end of the period. So somewhat related, the SEC has stated that all of the following conditions must exist before revenue is recognized. 1, there has to be persuasive evidence of an arrangement that exists between the company and the customer. A product or service has been delivered to the buyer, to the customer, and then the seller's price to the buyer is fixed or determinable, and then 4th, collectability is reasonably ensured. So stated a little bit differently, the SEC says that before a company can recognize revenue in an accrual accounting system, a business has to have some sort of firm commitment from the customer that a sale will occur. Then 2nd, that a product or service will be delivered to that customer. And then 3rd, a price for the service or the product is agreed upon between the business and the customer. And then 4th, the business has confidence it can collect from the customer. Check out the Enron video that's part of this week's materials, and you'll see that commitment or that confidence in collecting from the customer really wasn't there. Okay, I'll be available for virtual office hours on Tuesday evening. I've also attached a link to the homepage about a survey that I'm doing. I'm working to improve my teaching methodology, so take a moment to do that survey and give me some feedback. All right, remember, God is on his throne. He's always been there, and he's always going to be. Have a great day.